It's game over, Fed, as over $300 billion in bond losses could get dumped on taxpayers. I'm your host, Steven Van Metre, and thanks for joining me today. And following one of the biggest bond routes in history, the Fed is now sitting on over $300 billion in unrealized losses on their bond holdings. Central bankers say it doesn't matter, but maybe it actually does. Let's over to the Wall Street Journal, where we start today's story out with the headline that New York Fed flags scenarios where central bank could see losses. The Federal Reserve could reach a point where it no longer has profits to hand over to the U.S. Treasury should the central bank raise interest rates beyond what the market expected as of this spring. Now, if you're wondering how this happens, how the Fed actually gives money back to the Treasury, well, they do, and it works kind of like this. The Fed effectively doesn't actually print money, but creates money out of thin air to swap with the banks and buy U.S. Treasury and mortgage-backed securities. They then collect the interest off that, some of which comes from taxpayers like you and I. Then they use that money to pay their expenses, and whatever they have left over, they give back to Congress. Think of it like a tax refund. Now, I know some of you are shaking your head right now, and I totally understand. Let's continue on, because the Fed could see paper losses on its bond holdings, and likely did at the start of this year. The findings came in a report detailing activities around the Fed's massive balance sheet last year, as the Fed's holding of cash and bonds reached a whopping $9 trillion as it bought assets to stimulate the economy. But those holdings are set to start shrinking tomorrow on June 1st, as the central bank begins allowing some of the Treasury and mortgage bond it owns to mature and not be replaced. Reports said the balance sheet could be on track to shrink to about $6 trillion by 2025, but as we all know, there's no way the Fed is going to continue to unwind its balance sheet that long. As soon as we have the next recession, well, it'll all come to an end. But hey, it can be hopeful. The Fed is now raising rates to lower inflation, and its benchmark federal funds rate target is now between 0.75% and 1%. The Fed is expected to raise rates by half a percentage point at both the June and July FOMC meetings, the June one in now about 2 weeks, with more increases of uncertain size seen likely after that. How high interest rates will have to go to help lower inflation that is now at a 4-decade high remains uncertain. Rising rates mean the Fed, which pays banks, money funds, and others to park cash at the central bank, will face higher costs to achieve its monetary policy goals. The federal funds itself from increase in earned off bonds it owns and from services. And here you can see on those reserve assets that the Fed creates to go out and buy treasuries and mortgage-backed securities. Well, they pay 0.9% or 90 basis points more than what many people get on their savings accounts. And how about the money market funds, which the Fed is currently backstopping? Well, there's over $2 trillion in overnight reverse repurchase agreements, which the Fed also pays interest on. And last year, after it covered expenses, the Fed handed back, if you can believe this, $107 billion to the Treasury, the central bank said at the start of the year. As it raises rates, it faces higher expenses, and depends on how far short-term rates go up. Those costs can eat up all of the Fed's earnings, so it can't hand any more money back to the government. Now, you can only imagine, if you're in Congress, what they would think about having a tax refund that now could be a tax bill. In the report, the New York Fed said the March surveys it conducted saw market participants projecting a federal funds rate by up to 2.625 by the end of 2024. If interest rates are a percentage point above that expected path, quote, net portfolio income is negative for a short period of time due to higher funding costs of interest paid on reserves. If interest rates were to rise 200 basis points or 2% higher than indicated in the March surveys, the net portfolio income would be negative for roughly 2 to 3 years. And these projections for net income and higher interest rate scenarios would likely result in the cessation of remittances to the U.S. Treasury for a short period of time. In such a scenario, the Fed would turn an accounting tool called a deferred asset, which would allow it to operate under a loss, the bank said. And we'll get to that more here in a little bit. As net income gradually increases above zero, the deferred asset is reduced and remittances resume once the deferred asset is extinguished. So if you could only imagine, the Fed actually has a way to sit on losses on its balance sheet, something no other investor has the privilege to do. And no, it's not going to be a good thing. Losing money doesn't impede the central bank's ability to conduct monetary policy, but it could create political headaches. The money the Fed returns to the Treasury may be relatively modest, but it adds up over time and helps curtail deficits. Lawmakers could take issue if the Fed's steady stream of Treasury remittances turns to reported losses if the central bank's policies aren't carefully explained. And the losses the Fed alluded to on its bond holdings exist only on paper, of course, as the central bank holds its securities to maturity. Still, the paper losses could be significant, as last month, top Fed staffer said that the Fed on paper had lost about $500 billion on its holdings over the first 3 months in this year. In the report, the Fed said if the Fed funds rate comes in a percentage point higher than March's expected path, the unrealized loss in Fed holdings could hit $800 billion. Now you imagine we have a central bank that is buying U.S. Treasury and mortgage-backed securities and then selling them at a loss and sitting on the loss. That could have dire consequences for the economy and monetary policy. But one thing it shouldn't have dire consequences on, and that's your portfolio. I'll put a link up here in the corner to Portfolio Shield and the description below. Let's dig deeper into the story, because the situation, it doesn't sound like it's going to get any better. And the notion that these central bankers can sit on a loss, I don't think it turns out as good as they think. Higher rates raise the risk of future Fed losses, as for now, break-even levels of the Fed's benchmark rate, the point at which the Fed would pay more interest than it earns, is around 3.5%, according to the latest projections from economists at Deutsche Bank and Morgan Stanley. The federal funds rate is currently in a range between 75 and 100 basis points, and investors in interest rate futures currently expect rates to rise above 3% in a year. And so what happens if the Fed runs a loss? Well, according to the Fed, it doesn't matter, but the central bank can't run out of money. It wouldn't turn to Congress hat in hand. Instead, if you can imagine this, it would relabel such a loss by creating a new entry on its balance sheet called a deferred asset. In years where the Fed again has a surplus, it wouldn't hand over the surpluses to the Treasury Department until it first repaid itself back, erasing the deferred asset. And wouldn't that be nice as an investor if you had a loss that you could just book it on your balance sheet as a deferred asset and cover it later? Well, it would be nice, but we're not the Fed. But that's the plan, is for them to sit on a loss. But is that a good thing? Well, not really. Would this constrain the Fed's operations? Well, no, of course, the Fed says it won't. Losses have no direct implication for monetary policy, according to the chief economist at Deutsche Bank. Sure, let them run trillions of dollars in losses and it won't matter. But it could create a political headache for the central bank, potentially at a time of growing unhappiness with the Fed if, for example, inflation stays high, or if the Fed's efforts to combat raising prices puts the economy into a slump. And the prospect of capital losses could have implications in both the short run and beyond. Officials have discussed potentially selling mortgage-backed securities in the future, which we'll get into a little bit more in the show, to more quickly accomplish their objective of holding mostly treasuries on its balance sheet. But any such sales could incur losses because the value of those bonds has fallen, with the Fed signaling higher rates ahead. So now when you hear about the Fed unwinding their balance sheet, what they're going to start doing on Wednesday, tomorrow, is they're just going to let maturing bonds roll over. The Treasury will pay them out and everything will be fine. Well, those are not taking a loss on. But if the Fed starts actually selling its balance sheet, well, now we're talking about booking another type of loss and building another deferred asset that the Fed will have to cover. Those losses would not entail any operational challenges. Of course not. That's what the Fed always says, but would pose communication challenges. I think people would not like to see the Fed with a loss on the books. But Mr. Carpenter, a former Fed economist, said central bank officials aren't likely to intentionally make bad policy decisions to avoid having losses. But he said when forced to choose between two policy options that would have roughly equivalent economic outcomes, you might choose the one that doesn't give you the headache of having to explain why you had losses. And you can only imagine Fed Chair Powell having to go, or a future Fed Chair going in front of Congress and having to explain why they're buying bonds and taking a loss. It doesn't actually work out all that well. And over the longer term, capital losses could underscore a risk that the Fed asset purchases, that some critics of those purchases say ought to make the Fed more skeptical about their use going forward. Because this is a real cost to taxpayers, you've taken on the real risk. And the risk as a cost that should be considered. If Congress gives Fed grief around declining income or threatens its operational independence, then Fed officials in the future could become less willing to use those tools as aggressively as they have in the past. And that, my friends, is the actual story here of what this could entail, is because if the Fed runs an operation that ends up in a loss and puts them perhaps in a situation where they're constrained to use monetary policy tools in the future, well, that could be the next recession. The Fed wouldn't have the guts to go out and do QE due to the lack of popularity and as taxpayers find out, well, it costs them too. And yes, the Fed's going to keep hiking as Fed's Waller backs half-a-point rate hikes in several meetings. I support tightening policy by another 50 basis points for several meetings. He said in particular, I'm not taking 50 basis point hikes off the table until I see inflation come down closer to a 2% target. And just keep in mind, it's over 8 now, and inflation is a lagging indicator for it. So for it to come down to 2, it's going to take a while. And according to Waller, that means a lot more hikes. Officials are counting on a combination of higher rates and quantitative tightening to rebalance supply and demand that was pushed out of line during the pandemic due to fiscal and monetary policy. Waller said that various economic models suggest that overall reduction in the balance sheet would be equivalent to around a couple 25 basis point hikes, while cautioning such estimates were uncertain. And that is another issue, because here we're facing 2 weeks from now, the Fed is going to raise rates by 50 basis points. It's largely baked in the cake, as they say. But every month on top of that, we're going to have effectively 2 more rate hikes due to the effects of quantitative tightening. And that's something the market says is priced in. But I don't think it really understands just how tight things are going to get and how quick. And Fed fears hit mortgage bonds, attracting investors as money starts flooding in to these bonds. And analysts worry that Fed sales of existing bonds could flood the market, driving down prices. And that is the belief that mortgage rates are going much higher as bond investors demand more compensation to lend money. That would boost mortgage rates and destroy the housing market, because bond yields act as a benchmark for real estate lenders. And rising rates over time tend to cool the housing market, which after 2 years of surging prices, as we just talked about in a recent show, has widely been described as overheated. And some investors who specialize in the normally placid agency market are raising new funds to buy up these bonds, hoping that interest rates go down. And one bargain hunter is Analyte Capital, and their chief executive said they're using borrowed funds. You can imagine, borrowed funds. They're borrowing money to buy distressed mortgage bonds. Think about that. To boost returns on its investments, purchases of agency bonds at current prices are likely to yield annualized returns of 12 to 15%, up from 10% at the end of 2021. And well, are they right? Are they taking a big bet? Well, here is the monetary base, the Fed's balance sheets, and I've circled and overlaid 30-year Treasury yields. Here's where quantitative tightening started, roughly in October of 2017. Here's where it ended in October 2019, and rates continue to fall as they were rolling over and heading into the pandemic. So this is a big bet that rates may still go up a little bit more and then come crashing down, meaning the Fed could find a way to get out of this. And while those taking big bets in the bond market may come out looking like a rose. I'm Steve Van Metre. Thanks for watching. Thanks for being a fan. Bye now.